The impact of Federal Reserve interest rate changes on your wallet. The Federal Reserve cut its policy interest rate by 0.25% in September 2025 to a target range of 4.0% to 4.25%. This was the first rate cut since December 2024 and marks the start of a potential easing cycle to support a weakening labor market despite ongoing inflation concerns. The Fed projected additional rate cuts through the rest of 2025 and into 2026, anticipating a target rate near 2.9% by the end of 2026. Impact on your wallet. Borrowing costs decrease. Lower federal funds rates typically lead to reduced interest rates on mortgages, auto loans, credit cards, and personal loans, making borrowing cheaper. Mortgage rates could fall. Rate cuts often translate into lower mortgage rates, potentially saving homebuyers thousands over the life of a loan and reducing monthly payments. Credit card and loan rates. Reduced rates help cut interest payments on credit cards or variable rate loans. Savings and investment returns. Lower interest rates mean reduced returns on savings accounts and fixed income investments like bonds. Stock market impact. Rate cuts can boost investor sentiment and stock prices, possibly enhancing portfolio values. Inflation and employment balance. The Fed is trying to balance inflation containment with supporting jobs, so consumers could see more stable prices but moderate wage growth. What to watch? Monitor upcoming Fed meetings as further rate cuts are expected. Look for changes in mortgage rates, loan offers, and credit card APRs. Adjust your financial planning to consider the cost of borrowing versus lower returns on savings. Look for changes in mortgage rates, loan offers, and credit card APRs. Adjust your financial planning to consider the cost of borrowing versus lower returns on savings. This topic helps readers understand how Fed policy affects everyday finances, from loans to savings and investments, which is highly relevant in the current economic landscape.